Hi, this is Robert Kiyosaki, and you're listening to Capital Hacking. This is the most important thing you can listen to today.
Hello, this is Josh McCown, and I'm sorry for interrupting the beginning of your favorite podcast. I know, Robert Kiyosaki, Rich Dad, you're going to have to wait a second before we get started because it's time to announce something very special. Learn and grow. Have you heard this expression on the show before? Learn and grow is a time for us as a capital hacking tribe to get together, come together within the Accountable Equity Learn and Grow Mastermind Summit hosted at Renault Winery on December 2nd and actually become a community, a mastermind. Remember Jim Rohn, the great business philosopher? He said, we will become the average of the 5 people we spend time with. And wait until you see how great the people are in that room. There's a community from all over the country that'll be flying in. We'd love to have you join us. There'll be great speakers, great content, and you could be in that room. If you haven't had a chance before, please visit the accountableequity.com site, choose Learn and Grow, and register today.
Here's the one.
I have a dream.
With great power comes great responsibility.
I could do this all day.
This is it. Don't get scared now.
They may take our lives, but they'll never take our freedom.
Cinderella's story out of nowhere.
It's in the hole. That the only thing we have to fear is fear itself.
Welcome back to the big show, John. This one's a big one.
I'll tell you what, it's so necessary that we just had the conversation with Steve Sue, because there are so many of our listeners that are out there that are getting involved in syndications without doing their due diligence. And Mr. Sue, Dr. Sue, he wrote a book. It's called Avoiding Rookie Errors as a Left Field Investor. And he talks about how he invests passively and how he vets the syndications he's investing in.
Yeah, lots of lessons, 20 lessons in this book. Okay, so Steve's been an investor with us for a long time, but also he's one of the co-founders of Left Field Investors. So you're going to hear some backstory on that. You're going to hear how a doctor finds his way into real estate investing 18 years ago and some lessons he can teach us from that. And you're going to just hear some of his 20 lessons. He picks out like 1 or 2 of the best. Oh, and by the way, I'm holding a signed copy of this book. So if you would love it, go to Amazon right now. I think he charges like $2 for this book. It's great. It's not for money making. He's a great guy, great concepts. I think you'll enjoy it. You're going to love this episode.
Let's go.
John Edwin, you and I are so honored to have the illustrious Dr. Steve Sue on this big show. Steve, welcome to the big stage.
Thank you very much for having me on, guys. I love your podcast.
Thank you. Steve, can you give us a background of who you are and why you're so amazing at what you do? Because I know this information is going to go out there to our listeners. It's going to be amazing.
Mm-hmm. Yeah, so first of all, I am married to my lovely wife, Daphne, of 27 years, and we have 3 wonderful adult children who are in their 20s. They're making their way into the real world after college. I am an ophthalmologist in private practice for the past 25 years. I still work full-time in my practice. And then we get to real estate investing, and that has been a passion of mine for the past, say about almost about 18 years, maybe. Started off with my office condo that we bought for our practice, and then moved along and did some private lending to flippers, and then did some active real estate investing in single-family homes and duplexes, that kind of thing. Didn't really like that, so I've decided to sell those, and I'm all in on passive investing in syndications at this time, and that's all I do in terms of my real estate portfolio, is just investing in syndications. And along the way, I met some guys at a meetup, and we started a group back in March of 2020 called Left Field Investors. And Josh, you've been instrumental in helping us getting that going and sponsoring and being a speaker on our monthly meetings and that kind of thing. So that is a community of passive investors who are interested in syndication investing, and we have virtual networking and a private forum in there as well, which educates everybody and just ups the level of the game for all of us.
So if I may jump in, Mr. John, is that okay? So
Absolutely.
I'm excited to have you on the big show here, Steve. And you dabbled. We're going to ask based on that bio you shared. I love the chronology. 18 years of investing in real estate, which means it sounds like you did it. Did you do it accidentally when you bought the condo? And then did you learn something from that experience that opened your eyes? Maybe I'll hone in a little more about the beginning.
Right. Of course, as many people, I read Rich Dad Poor Dad in 2002 or 2003, I believe, and that changed my mindset about investing. I lost a lot of money trying to be well, not a day trader, but a night trader, because I was working full time doing the stock market thing back in 2000, 2001. Actually, in the early 90s, late 90s, I started doing that. Thought I was a genius in the stock market investing, and then of course 2001 hits, and lost a lot of money in the stock market doing that such thing. So I decided that maybe I should look at other avenues. And I read that book. It's changed my life and my philosophy on finances and investing. And so moving along, my partner and I were in an older condo in a not so great part of town. And we decided to move because our lease was going up. And so we moved about 3 miles north of where we used to be in a suburb of Columbus called Westerville, in a wonderful area. And it was a new property. Actually, we are the anchor tenant, so the developer decided to develop this around us. And so it is a 3-story building, but our office condo just takes up about 2/3 of the bottom floor.
And you bought it as an ownership strategy, which
Yes.
meant you had an asset growing in value. Were you surprised by the early benefits of owning real estate as a company with some depreciation, or were your eyes already wide open to everything that was going to happen about real estate?
Well, it was exciting to get started on that journey. As you know, there's a lot of different aspects, tax benefits and that kind of thing with owning your own real estate. And I like when I pay rent and it goes back into from my right pocket, goes into my left pocket. I really like that. Of course, it's a triple net lease, so our practice pays for all the different things that normally I would pay for if I were to own a single family home, for example. So, yeah. So, anyways, that was a nice benefit, and to this day, we still own that condo, and I don't think we're going to sell it until we sell the practice or I retire or whatnot. So.
There's one other couple things. One, I'm going to just ask, when you started learning how to do private lending, which we're probably not going to be able to go too deep on that, but did you use your IRA to do that, or did you do that differently? And was that a new strategy you learned over time?
I did not do the direct private lending to flippers through my IRA. And actually, I'm trying to think back at the timeline. I believe I had that money already into some debt funds that I was doing. So the private lending actually did come a bit later. I think that was probably maybe about 7-8 years ago when I started doing that. I only did that for a few years actually, and I was getting 12 to 14% returns, which isn't nothing to sneeze at, but that was a nice return. But I had to keep turning that money over and over. Right. Every 3, 4, 5 months, I had to keep turning that money over, trying to find new flippers. Or sometimes the timing wasn't right, so I'd have to wait. So there's a little bit of a cash drag on that. So I probably wasn't getting quite 12 or 14% returns annualized. Oh, so that's where syndication investing really caught my eye.
Yep. Well, I have a few questions, John. If you'll let me, you can interrupt me anytime you want, though, buddy. I'm a big fan of Steve's and all the work he's done. So I know the end of this great journey where it is today with left field investors. But I want to almost do a whole segment on left field investors. So before we get to left field investors, you keep using this word, or maybe you did it off show, syndication. So teach me about when that word shows up in your life, and what is it for our listeners who don't know what it is?
Right. The funny thing is, I actually invested in a syndication before I even knew what the term was. I didn't know that that's actually what it was. I did an oil and gas syndication, which we can certainly talk about down the road here. But a syndication is, for all intents and purposes, a pooling of money and resources. And you have essentially two players. You've got the general partner and you've got the limited partner. And you can have multiple general partners in a deal. You can have multiple limited partners in a deal. And so they all get together. Generally speaking, the LPs, the limited partners, have the money, and then the general partner is the one who has the deal, and they vetted the deal, and they try to sell it to the LPs. They put together the paperwork with their attorneys, and then talk to their accountants and everyone else involved, and find property management and that kind of thing. So it's a gathering of people for one purpose, to invest money and hopefully to make money.
Yep. And we'll get into a little more about that later in the show. But John, Edwin, go for it, brother.
Well, I love that definition. Great job. And I think a lot of our listeners are involved or looking to get involved in syndications. If you're okay with this, Josh, I know you created Left Field Investing and you wrote a book. What can we talk about some of the pitfalls, some of the things that you want to look out for, some of the things that you want to avoid with syndication?
What's the name of your book, Steve? We'll start with like John said. Yes. Why did you write this book?
Right. It is called Avoiding Rookie Errors as a Left Field Investor. And it actually came out of a blog that I wrote for our website, leftfieldinvestors.com. And it was originally titled 13 Lessons Learned in 13 Years of Syndication Investing. And that was probably one of the most, I would say, popular blogs that I wrote out of the several that I've written for LFI. I got emails, I got phone calls, that kind of thing, to talk about essentially the mistakes I made in syndication investing. And I think it was because I was being vulnerable to the audience that they really appreciated that. A lot of times when you talk to sponsors, it's all roses and things are just great, and they don't talk about the risks as much, even though in the PPM they have it all capitalized in the first few pages, and saying that you can lose all your money, and that's absolutely true. So when I wrote that blog, I thought, well, I think people need to learn from my mistakes so that they can not lose money like I have. So I took that blog and I essentially wrote a longer version of it, probably about 5 times as long as that blog. And we published it on Amazon, so you can find it on there. There are 20 lessons that I put on there, and I talk about them to some length. It's not the longest book in the world, but it does have, I think, a lot of valuable information. If you want me to go through some of the lessons, I can talk about some of the important ones.
Yeah, and this will be where we flesh out Left Field Investors a little bit. Is that okay, John?
Yeah.
So Left Field Investors, which is the publishing group that you used to write this book, is a group that you were one of the 5 founders of, correct?
Correct.
So as you go into the book, why don't we backtrack and talk a little bit about Left Field Investors and what is it? And we'll keep repeating this, but you can find this book on Amazon right now, Avoiding Rookie Errors as a Left Field Investor by Steve Sue. Go ahead to Amazon right now, grab this for no other reason other than to get the good message out that Steve has put a lot of energy and time into. It's probably a 2-hour read or less. And from there, you'll be eyes wide open in the world of direct investing. But let's go back to Left Field Investors. You said something crazy. You said it got started in 2020. That's the year of the COVID. Did you guys do it because it was COVID, or was it going to happen anyway? Then the COVID got involved in your story. What is Left Field Investors?
Yeah, that's an interesting story. So the group started out as Jim Pfeiffer, as you know, it was the real starter of this whole movement, if you will, Left Field Investors. He and I got together. He was going to do a presentation at an active real estate meeting in Columbus, and he said that I'm going to talk about passive investing, and that was kind of surprising to me because I didn't know at the time, and back in 2019, I didn't know any passive investors in the Columbus, Ohio area. I thought I was the only person. I'm sure there were others, but I didn't know of any. So I immediately emailed him, and this was fall of 2019, and he did the presentation in November. We just hit it off right then and there, and then in early 2020, he said, I'd like to start a local meetup so we can teach people how to invest passively in these real estate syndications. I said, sign me up. I'm there. I'll be there for dinner. And so we were supposed to meet middle of March of 2020. And then, of course, we know what happened at that time. The pandemic hit. So we said, well, let's just do this on this thing called Zoom. And so we did, and then I think we had about 12 people or so on the Zoom meeting. And after that meeting, we said, well, if we're going to do it on Zoom, why don't we just invite our friends from across the country to meet up with us? And then ever since then, we've had monthly meetings, and each time we had the monthly meetings, we'd have more and more people. Now, back then, we weren't actually called Left Field Investors. We were called the Columbus Passive Income Group, or Passive Investing Group. That's it. CPIG. I didn't think that would really fly. So we decided to change the name, and we came up with Left Field Investors. And the people asked why Left Field Investors, and actually ran into Ken McElroy at a Passive Income MD conference a couple of months ago, and I told him about Left Field Investors. He said, why did you pick that name? I said, well, Jim, our true founder, said, we need something kind of quirky like Bigger Pockets or Motley Fool. And so he came up with Left Field Investors, because when people who are in traditional investments find us, they're like, well, you guys are investing these alternative assets, so you guys are out in left field. So I said, oh yeah, that's a great name. I think we should be called Left Field Investors. So that name stuck. And then Josh, you're holding up the meetup agenda from our meetup last month, and thank you very much for attending. By the way,
box scores. It's like so from a quirky. I'm sorry to interrupt you, Steve, but I just got to add some color commentary, because you're right. I got to meet you guys early on in the generations, and I remember, John, it's Steve just volunteered one of the punchlines, but they're not actually about baseball. I know, you know what I mean? Left field is the left field of a baseball diamond, right?
Left field, yeah.
Right.
I get it.
Well, they're not actually baseball. You would think like two of them were baseball coaches, or one of them was like a historian of the game. How many of you guys are aficionados of the history of baseball?
I don't think any of us really are. I used to follow baseball when I was little. The Big Red Machine was my team, but I don't remember the last time I actually watched a baseball game.
So, John, check out this picture. They all wear jerseys like they're on a baseball team, okay? Their paraphernalia has real, like, awesome pictures of baseball. Check this out, John. You'll love this. Their box scores, like, this is the agenda for the day.
Wow.
Here's my point. Talk about a group that took a name and just dove deep into the branding of baseball. And whenever you're with them, they always say, we're not actually baseball guys. We just thought it was a good thing.
No,
but they do it so well. I will say way better than Bigger Pockets does. Like, Bigger Pockets doesn't have pictures of pockets with cash falling out of it everywhere, or pockets getting fatter the more they think about real estate. No, they just have one pocket. It's in the logo. You guys are all in on baseball.
Oh yeah.
For those
all in.
For those listening, Josh on video is holding up an agenda, I guess a monthly agenda that it's like a program that you guys designed. And I thought when you picked that up, Josh, because it looks like old school, like out of the 20s, I thought it was an old baseball magazine. I didn't even know it was, an agenda for a meeting.
They just had this big national meeting that I got to go to. I didn't get to speak at it yet. I said, I'm on the waiting list, though. They say maybe in the future I get to speak. But I got to go to it, and it was awesome. Look, they even did this, John. They made baseball cards for each of the speakers, bro.
Great.
Dude,
that's great.
And they made them look old schooly and old timey. You guys are like all legit about this. And then they made the pages when the people were speaking here. You can write down the notes about that
you could
baseball.
take notes.
I'm telling you, really good stuff. And that's not even like your passion, baseball or graphics. But I'm really proud of you. That's why we want to get everybody to buy the book, Avoiding Rookie Errors as a Left Field Investor by Steve Sue. Sorry for all that deep dive into the branding, but you're right. It is a quirky name, and you've done well. How big is your organization? How many states and countries do you think it has touched now?
In terms of states, I'm not really sure. I'm sure we're probably in the 30s or something like that, maybe more than that. I believe we have about 1,800 members at this time in our group. And we have an inner circle membership group, which we call, as you know, the infield.
And every meeting is like a coach's call, or what are they called? Like a plate call?
So we call the virtual meetings mound visits, because the coach comes out and talks to the pitcher and can coach them. So we call them mound visits, because all the people in the infield walk up to the mound, and they have a little powwow there. So that's what we do. Yeah.
It's so
And then, of
deep.
course,
The branding.
and
Is
of
so
course, I
deep.
have to continue this since you're asking about this. But so we call the left fielders people who invest in alternative assets, right? Because people think we're out in left field. And then, of course, the people I'm holding up my right hand because the people who are in right field are the traditional asset investors. They invest in stocks and bonds. And then you have me in the center, who's a center fielder, because I do have a 401k still. And so I invest on both sides. And so we call them center fielders. So
I love how good it is. And we want to go, there was one more part I wanted to talk about with the left field. Here's, for anybody listening, you're like, why the hell is Josh so worried about baseball? And all that. Steve Sue represents this movement that got created around Jim and Steve and Chad and everybody else's names. I'm sorry, I got to look
Sean
at my
and
roster.
Ryan and
Sean and
yeah,
Ryan and
Pat,
Patrick
yeah.
Wills now. So picture this, folks. It is a dynamic group of salt of the earth people that actually just do what they say they're going to do. And mostly they've grown exponentially, I believe, because they're just trying to aggregate good information. And they're trying to have a lot of direct access to people that either have deals and all these gentlemen and ladies that want to find out about deals, and maybe they need to hear about 5 deals before they invest in any deals, right? Well, how do you do that? It's not like Vanguard where you can just click a button and see all their investments. There's like this aggregation of private deals, direct private deals, and you guys are kind of out there trying to find sponsors that you want to let speak about their work. And you're out there letting more and more and hundreds of more families like your families join so that they can at least have access to direct deals. So the you guys exist in a vortex where I don't think many companies exist, right? You're really in more of a nonpartisan platform of conversations around the mound. So,
Right. Yeah, I like to say that we're like Switzerland. We don't like to tout deals. We do not co-GP deals. We do not make any money based on a percentage off of the deal webinars that we do. We just take a straight flat fee from anyone who wants to be in front of our group. And that's hopefully that's the way we'll always be, because I don't want to be tainting our brand, if you will. I think, for example, Bigger Pockets kind of does the same thing, where they don't really, they're agnostic, in other words. So they don't want to persuade someone to do something versus something else because of the money that's coming in. Right. Yep. And our fees are very low for the LP investors as well. I mean, it's, if I may say it, it's only $199 a year for the infield membership, which is actually less than a Bigger Pockets membership. But you get access to our private forum, which sponsors like yourself cannot see some sections of it, which is good because we don't want people to sneak in there and talk about things that we don't want to be hearing about, that kind of makes it kind of look rosy, et cetera. So yeah, it's a private group, and we always want to keep that a private group as well, because I think that you get true conversations, sincere conversations in there.
I'm sitting here thinking about March 2020, the world shut down Friday the 13th on March 2020. And you, Steve, were just trying to meet a couple people and invest in some deals passively. Mm-hmm. You're a doctor, you have your practice going, and then you have a Zoom meeting, which no one really knew what Zoom was like they do now. Obviously, this is just part of our everyday life now. But and then it just grows and it grows, and now you have 1,800 members. Like, was that even an intention? It seems like you just wanted to connect with a few local people and vet deals, and now you have 1,800 members. Like, that's amazing.
Mm-hmm. You're absolutely right. We did not know what we were doing. We were originally 5 founders, and we would always say we're 5 guys trying to figure stuff out, and including how to do the Zoom meetings. Because if you go, you can actually see our very first Zoom meeting. We're trying to figure out how to work this thing. But yeah, it was just kind of a grassroots movement. People would invite their friends, and then friends would, invite their friends, and then they would see our website. And Jim was instrumental in trying to get the word out because he was on a lot of other people's podcasts. And then he started the Passive Investing from Left Field podcast as well, which has been very popular. So that has really gained us a lot of traction as well. But absolutely, we had no intention of making this a huge movement or trying to emulate even a percentage of what Bigger Pockets is doing. But we call passive investing and syndications a team sport, and we really love the community, because without your network, it doesn't really matter how much you know about a deal or how good you are at underwriting a deal. If the sponsor is not a good or an ethical sponsor, you may actually lose all your money.
Wow.
So that's the power of this community.
I have a few questions, and Josh is chomping at the bit. I see him muting and unmuting. And so you said it's $199 a year, is that right, for the infield?
Yes.
The infield, right?
Right.
And then, okay, so two more questions, and then, because I'll let Josh go, because he's pulling at he's ready to go. One is, how do you vet members coming in? Like, what are the qualifications? And number two, how do you vet the people, like the syndicators that are coming on to present a deal to left field investors?
Mm-hmm. Right. So for the membership, anybody can get onto our free newsletter. Just go to the website and you can get on the free newsletter. And then in terms of getting into infield, there is no vetting. We can have a call. If you would like to talk to one of the founders, you can talk to one of 3 or 4 founders of LFI if you have questions or whatnot. But we do ask, if you are a sponsor or a capital raiser, that you do put that in your bio, so that we can put infielder / sponsor or infielder / capital raiser. And there are certain sections that we do not allow sponsors to go into in our infield private forum. So in terms of actually vetting the members, we do not actually vet them per se. So they could be lying to us, I guess, and they could sneak in there and maybe put in a good word for a sponsor. I suppose that can happen, but I don't know of any members who have done that yet. But in terms of the who can present in front of our group, well, they would have to go through a process of talking to one of the founders and just make sure that they check out, and then we would do some of our own research in their group, make sure that they're a group that's reputable. And they can start off by doing what's called lunch and learns, which are just short segments where they can talk about the industry, such as self-storage or mobile home parks or RV parks and that kind of thing. So they can do more of a teaching webinar. And if they have a deal coming up, they can certainly do one of what's called a deal webinar, and they can present their specific deal at that time to our group. And we record them and put them on our YouTube channel. Of course, those would have to be 506C dealings, because you can't do the 506B deals. You can't advertise them per se. But anyways, so we always have huge disclaimers. Again, we are not touting one deal over the other or one sponsor over the other. So we have huge disclaimers saying that this is a do-it-yourself group. We are not here saying that this is just because you're on a webinar. We are not here to say that you should invest in this. You need to do your own due diligence. You need to talk to your own, community advisors, etc., before you invest in any deal.
I love it. Josh, can we talk about the book now?
Yes, I do want to talk about the book, and let's dig in. So, avoiding rookie mistakes, rookie errors. Forgive me. You're so thematic to baseball. Errors. Now, is the context here, all 20 of these lessons, is it contextually passive investing only? Because that's your calling as a company?
Right. I guess you could probably say that you could take some of these lessons and apply it to someone who's an active real estate investor, I guess. But these are all things that I've learned over the years. I didn't make every single one of these mistakes, but these are things that I've learned. And just I do start the whole book off talking about complications from surgery. And I as an eye surgeon, that happens, and any surgeon will have complications if you do enough of them. And the goal is to minimize as many of the complications as you can. And I talk about, when I go to my national meetings for ophthalmology, many of the cataract surgery lectures are not actually about new techniques. It's about how do you minimize your complications. And so
smart.
That's what this book is about, is how do you minimize your quote unquote complications when you invest in a syndication. So these lessons are not all the one, fortunately, not all the ones that I've actually learned personally from trial and error, but I did have a lot of these, unfortunately, in my 14 years of syndication investing.
So there's good lessons in here. I'd love for you to pick out your top one or two and teach us.
Sure. Yeah, I think we talked a little bit about the first one that I always mention, and it's networking. The chapter is called Network, and you really have to surround yourself with a community of passive investors in this, I call it industry, I guess, because like I said, you could be the best underwriter. You could be probably a syndicator in apartment syndications, but let's say you want to invest in mobile home parks, but you don't know much about that space. Well, even though you know some of the underwriting aspects of mobile home parks, you may not know things about locations or what they do with these septic tanks and those kinds of things that are really important and really expensive, apparently. So you really need to have a sponsor. You really want to be investing with a sponsor who has been doing mobile home parks for years and years and years and has been through different real estate cycles. So, and how do you get to that point? Well, you can certainly talk to that sponsor, get an idea of what their experience is, and maybe get their track record. But first of all, you may not know if their track record is true. I would hope that they are being honest with you when they have their track record. However, if you talk to 12 or 13 people in our private forum who have invested with this person and they say, oh yeah, they're the greatest thing since sliced bread, I think that you could probably trust that opinion better than talking to a sponsor or even the sponsor's own references, because their references may be family members or who knows, their best friends, and of course they're going to talk them up as well. So I think having a team around you, an ecosystem, if you will, of passive investors who, especially when you have 1,800 of them, that's when you put, have you ever invested with accountable equity? Of course, everything we say about accountable equity is excellent, but sometimes some of these other sponsors, they'll say, well, this one gives me a little bit of pause. I didn't like their communication. Even though they gave me quarterly reports, I didn't really like that they didn't tell me this or that, and wasn't very detailed, or their distributions were spotty, those kinds of things. So these are details that the sponsor themselves will not tell you, and so you can get all their dirty details in a forum like ours.
That's fantastic, by the way. What is sorry, Josh, I'm gonna keep jumping in on you, bro. What are some of the things that you look for in particular when you're investing with a new syndication? Like what are those buttons that you're like, yeah, it checks all the boxes?
Well, in terms of a new syndicator, I'll certainly set up a call with them and talk to them for half an hour, 45 minutes. That's obligatory, in my opinion, to actually get on a phone and talk with them and ask them questions, and preferably a Zoom meeting. I think face-to-face is always better than just a phone call, because you can see their facial expressions and see what they look like. But I think that's important. Now, the one caveat with that is many of these bigger syndicators will have investor relations people who are great at sales, and so you have to really kind of dig deep on those, and hopefully you can get to the actual the syndicator themselves, or the operator, as we say. But yeah, that's one aspect right there. And then of course I will go to my community and plug in X, Y, and Z syndicator and see what they say about that syndicator. And then I will actually, look in, do some website searches and that kind of thing. I think some people would advocate doing background searches, which I personally have not done, but a lot of people in our group have done some of these background searches, et cetera. But I think one thing you also have to really look at, and this is another lesson, is the operator is a keystone of any syndication. And I've been using the word sponsor and syndicator and operator, I think, in this talk for kind of interchangeably. But I think the operator is the key person who is really running the show. I mean, if you have a multifamily syndicator, they're not necessarily the boots on the ground doing the property management. I mean, so I think when you talk to the investor relations person, you need to maybe try to set up a call with the sponsor, the actual syndicator. And then also you should ask the question, who's doing the property management? Because that they need to have a lot of experience as well, not just the asset manager themselves, who's a sponsor. So I think it's very important to talk to the boots on the ground people and see what they're doing, and then say, hey, can I get some references of other syndicators that you're managing for? They may have 10,000 units. But I think it's important to not only talk to syndicator A, but you need to talk to B, C, and D as well.
You know, Steve, let me compliment you on that. So, what you described are a few vocabulary words, if you don't mind me taking a stab at defining them, since you used them very fluently. One, you said asset manager. Of course, you said investor relations, which might be self-explanatory, but I think I want to flesh it out for those listening. And then you talked about the actual operator. So, one of the things that we stumbled into was when we were learning how to raise capital legally, safely, with high integrity. We went to a lot of seminars, joined organizations that taught us, and then, of course, hired great lawyers. But I remember a really important speech at the real estate guys seminars. I don't know if you know those guys.
I've been to that seminar.
Russell Gray gave a speech 6 years ago that changed a lot of what we did. And it actually is where the name Accountable Equity came from. And it's where a lot of the philosophy and business operations. He explained one really important thing. And I think I'd love to say this to people whenever I'm on shows. Raising money for real estate, and it seems so straightforward. Oh, we're raising money to buy this multifamily building. What's important to recognize, and Russ explained it well, as soon as you raise money, you're in the small private equity business and you're in the real estate business. So what we thought was important was to bifurcate those two so that everybody knew we took it seriously on two levels. Now, you also threw out there property management versus asset management. Now, those are the two distinctions that change the two business plans. So if you raise money, no matter whether you do it for one project or many, you are becoming the asset manager, where you have the overall global need to keep your eye on the entire idea of project. Once the money's been raised, how's it going to come back to the investor? What's the method? When's the next liquidity event? Those types of strategies. You're also the boss that hires the people below, which are property managers. So then you get down to property manager, and you use the term often of operator. And I thought that was great. You're really doing the right thing. So, what we focused on was having it vertically aligned. So the capital was coming in knowing the operations take priority so that capital can be returned. Operations are the key. You've said that multiple times. I'm looking at lesson 18. The operator is the keystone of every syndication. You also bring up lessons in lesson 1 that you have to start by investing in yourself, which is why you charge $199 to have people start to learn about the whole world of investing, which is a modest, fee to join your organization. Then you say network, lesson 4. 13 is the idea of a tribe. And, all of these key principles point back to one thing, and that is at the end of the day, you're handing money to people through this mechanism, and the people are buying the real estate or making it worth more. So it really is a people investigation, people discernment. People, the human capital, John, as we always talk about, is the key factor as to whether or not your money makes money. So I really compliment you. It seems like you guys are very good at articulating that. And I just want to throw it back to you, Steve. Did I nail it on some of your points there?
Oh, absolutely. I couldn't have said it better myself. But yeah, you mentioned those terms, and yeah, you defined the asset manager versus the property manager, and that I think there's a key distinction there, unless they are vertically aligned, as in your case. But yeah, I think you need to have conversations with both of those groups, not just one, because you are missing out. And even though the property manager could get fired by the asset manager, that's fine, but at least you need to know what you're dealing with in terms of who is on the boots on the ground.
And I'm just going to do a shameless plug for Chad Ackerman from Left Field Investors, who's going to be at Learn and Grow on December 2nd at Renault. This is our little attempt, Steve, at Accountable Equity to try to help minimize complications, as you started with. You said cataract complications are more talked about than cataract innovations. Complications are misalignment of who you're investing with. And it might even be two good people you could choose to invest with in their projects. But one is trying to pay back everything in 2 years, and one says it's going to have 4 years. Either one can be good, but you have to be aligned at what they're trying to achieve. And a lot of that comes down to conversation and relationship. And that's why Learn and Grow is so such a big investment for us, making sure we create a space for you, our investors, to come see us, or people that want to get to know us. I think that's a step in the right direction, and I think that's why Left Field Investors and we've always been so aligned. You just get to know the people you're putting the money into.
Right, absolutely. And I've been to your Learn and Grow twice now. And my wife actually enjoyed that real estate meetup. Normally she doesn't like those kinds of things, but she absolutely loved touring the facility and Renault. And, I learned a lot and connected with a lot of people.
Yep. And I bet you some people will join Left Field this year when they hear Chad, who's great at speaking about the mission. So we'll all be there in one room.
Steve, you absolutely crushed it today. As we close out, how do our listeners connect with you? Where do they find you?
Yeah, well, they can certainly go to, first of all, as Josh holds up the book, go to Amazon and buy my book.
By the way, I just bought it. I just bought it as we were on our podcast.
Oh, well, thank you very much. So so they can search my name, Steve Suh, SUH, or look up Avoiding Rookie Errors as a Left Field Investor. Our website is leftfieldinvestors.com. And if you want to email me directly, it's steve@leftfieldinvestors.com.
Yep. And we appreciate you so much. And thank you for being a partner with us. And thank you for all the hard work you guys are doing. I know you're not taking away big paychecks from Left Field Investors. I know it's a labor of love for you guys. And you're doing really cool stuff. Everybody's talking about you all over the country.
Yeah. Well, thank you very much for your time, guys. This is I had a fun chat with you.
Thanks, Steve.
Damn straight. We just got we got to the end of another great show. And everyone listening right now, you're the family and friends. Thanks for staying till the end.
That was so fun. And hey, hit the like, hit subscribe. We're here to serve you guys. That's why we're doing this show. Josh is not paying me. I'm doing this off of my quote unquote sweat equity because we want to make a difference in your life. And then that ripple effect will continue to touch the world.
Hey, amen, brother. Please check us out on capitalhacking.com, all the social media threads. And yes, I know you've probably already sent this episode to one of your best friends. Thank you. We love you. Just go right into your iPhone, hit the plus symbol. We'll talk to you later. See you next week.
Share.